Every investor dreams of it, right? Finding that one stock, that multi-bagger that just completely transforms a portfolio. But how do you actually find one?
So, you're on the hunt. You're looking for that next big opportunity. It's kind of the ultimate quest in the market, isn't it? It's the goal that drives so many of us to learn and to invest in the first place.
Okay, so before we dive in, let's just get one thing straight, a little dose of reality. The truth is, there's no magic formula. There's no secret indicator out there that's going to guarantee you a 10x return. It just doesn't exist. But, and this is a really big but, while there's no magic, there are proven rules. There's a framework that helps you systematically separate the genuinely strong stocks from all the weak ones that are just hype. And that's exactly what we're going to cover. We'll dive into Rule 1, which is all about fundamentals, then Rule 2, the technicals, and Rule 3, the business moat. After that, we'll look at some common traps to avoid, and we'll wrap it all up with a checklist you can start using right away. All right, let's jump into our first golden rule, strong fundamentals. The idea here is so simple, but it's absolutely crucial. A strong stock always begins with a strong business foundation. I mean, no matter how good a chart looks, if the company underneath is weak, well, it's just a house of cards waiting to fall. So, what does a strong foundation actually look like? Well, we can break it down into 4 key pillars. We've got consistent growth, low debt, high efficiency, and something we call promoter confidence. Let's take a quick look at each one. First up, growth. I mean, this is a big one. You want to see a company that has a proven track record, right? So look for consistent, steady growth in both their revenue and their profit for at least the last 5 years. A great example of this is a company like Asian Paints, which has just shown remarkable consistency, even when the economy gets tough. Pillar number 2 is all about financial stability, and the key metric here is a low debt-to-equity ratio. Basically, this means the company isn't relying too much on borrowed money to operate. High debt can absolutely crush a company, especially when interest rates start to climb. So the takeaway is simple. Less debt means more safety for you. Next, let's talk about efficiency. How well does the company use its money to make more money? We measure this with things like return on equity, or ROE, and return on capital employed, ROCE. Now, here's a good benchmark to just lock in your brain, 15%. If you see numbers that are consistently above 15%, that is a very positive sign that management is running a really tight, profitable ship. And the final pillar of fundamentals is promoter confidence. Now, promoters are the people running the show, right? The insiders. If you see that they are consistently holding on to or even increasing their stake in the company, that's a powerful signal. It tells you that the people who know the business best really believe in its future. Okay, so you've found a company with great fundamentals. Awesome. But that brings us to rule number 2, technical strength. See, having a great company is fantastic, but timing matters a lot. If the market isn't interested in that stock yet, your money could just sit there doing nothing for a long, long time. Technicals help us figure out when the market is paying attention. A key tool for this is the 200-day exponential moving average, or the EMA. Just think of it like a baseline for a stock's long-term health. When the price is trading consistently above this line, it's a really strong sign that the long-term momentum is positive. And it's not just about being above that 200-day EMA. A really healthy uptrend has a clear pattern. As you can see, it's a series of higher highs and higher lows, especially when you look at a weekly chart. This is the visual proof that a stock is in a sustained upward climb. But here's the thing. Price alone doesn't tell the whole story. I love this quote. It sums it up perfectly. Price tells you what's happening, but volume tells you who's making it happen. See, a price breakout on low volume is kind of suspicious, but a breakout on high, rising volume? That often means the big players, the institutional investors, are getting in. And that is a trend you want to be a part of. This leads us perfectly into our third and final golden rule, a concept made famous by the man himself, Warren Buffett, the business moat. This is all about finding a company's sustainable competitive advantage. So what on earth is a business moat? Well, think of a castle. The moat protects it. In business, it's a unique edge that protects a company's profits and its market share from competitors, not just for a year, but for the long haul. It's the secret sauce that lets great companies stay great for decades. Let's make this real with a few examples you'll definitely know. For HDFC Bank, its moat is built on decades of trust and incredible risk management.
For Dmart, it's a powerful operational moat. Their low-cost model is just so efficient, it's almost impossible for others to copy. And then you have a giant like TCS, whose moat is built on its massive scale and tech expertise in the global IT market. But here's a really important catch. Having a great moat isn't enough. The company also needs to be in a growing sector. Think about it. A fantastic company in a dying industry is still going to struggle. You want to find businesses that are playing in fields with bright futures, like renewable energy, electric vehicles, fintech, or defense manufacturing. The moat protects the castle, for sure, but the kingdom it's in has to be expanding. Okay, now that we have our 3 rules, it's just as important to know what not to do. So let's quickly cover a few common investor traps that can completely derail even the best analysis. First big mistake, and please don't do this. Don't chase cheap stocks just because the price tag is low. A stock trading for a few bucks is not automatically a better deal than one trading for hundreds. More often than not, these stocks are cheap for a very, very good reason, and that reason is usually a weak business. Next up, don't let short-term market noise or hype pull you away from your rules. A stock might be trending on social media, everyone's talking about it, but if its fundamentals are poor or its technicals are breaking down, that hype is going to fade, and investors will be left holding the bag. You got to stick to your framework. And this might be the hardest one to avoid. Don't hold on to a falling stock just because you're emotionally attached to it. Your money doesn't know you love a company. If the reasons you bought that stock in the first place are gone, you have to be disciplined enough to cut your losses and move on. So let's tie this all together. Here is your simple 3-rule checklist. Number 1, check for those strong fundamentals. You're looking for growth, low debt, and an ROE over 15%. Number 2, confirm the technical strength. Is it in an uptrend? Is it above the 200 EMA? And is there volume to back it up? And finally, number 3, identify that business moat and make sure it's in a sector that has future potential. So there you have it, a clear, logical framework for separating the strong stocks from the weak ones. The system is yours now. The only question left is this. You have the framework. Which rule are you going to check first?